All right, future CMAs, let's talk about something that I know can be a major headache in your Part 1 prep: consolidated financial statements. You know, if you've ever just stared at one of those problems and felt your brain kind of short-circuit, you are definitely in the right place. My goal here is simple: to take that confusion and turn it into real confidence. And look, I totally get it. You're trying to juggle parent companies, subsidiaries, intercompany transactions. It really can feel like a full-blown accounting tornado. But seriously, just take a deep breath. By the time we're done here, you're not just going to know how to do it, you'll actually understand why you're doing it. And trust me, that's the secret to crushing these exam questions. Ready? Let's jump in.
So before we even think about crunching a single number, we have to ask the most important question of all. Why do consolidated statements even exist? And it all boils down to this one really powerful idea: the economic entity concept.
Think of it like this. You've got a family, right? You have parents, you have kids. They're all legally separate people. But if you wanted to know the family's total net worth, you wouldn't look at each person individually. You'd combine it all. That's exactly what we're doing here. We're saying, forget the legal walls between the parent and the subsidiary for a minute. For financial reporting, they are one big economic family, and we need to show investors the whole family's financial picture.
Okay, so that's the why. But what about the when? When do the rules actually say you have to do this? What's the trigger that kicks off this whole process? Well, it all comes down to one little word: control.
And what does control mean for the CMA exam? It's a really simple bright line test. It means owning more than 50% of the subsidiary's voting stock. Not 50% on the dot, more than 50%. So even 50.1% counts. That is a number you absolutely have to burn into your memory.
Now, here's a classic exam trap, so listen up. What happens if a company owns, say, 30 or 40%? Well, that's called significant influence, not control. And in that case, you use a totally different method called the equity method. You don't combine the statements at all. The key takeaway is this: is it more than 50%? You consolidate. Is it 50% or less? Nope, you're playing a different game.
So, we have control. Great! We just add the parent's cash to the sub's cash, the parent's debt to the sub's debt, and we're done, right? Whoa, not so fast. If you do that, you've just created a financial statement that's, well, kind of lying. And that brings us to the most important part of this whole topic, and the part the exam just loves to test: eliminations. Let's make this super, super simple. Forget about companies for a second. Let's just talk about you. Imagine you, a single economic unit, have a $20 bill in your left pocket.
Now you take that $20 out and you put it in your right pocket. The money moved, sure, but it's all still yours.
I mean, of course not, right? And just like that, you've unlocked the entire secret of intercompany eliminations. The parent and its subsidiary are one economic family. They can't create new wealth just by selling things back and forth to each other. It's just moving money from one pocket to another. And to show the true financial picture, we have to get rid of those internal transactions.
So what exactly are we zapping from the books? For your exam, you need to know these big three like the back of your hand. First, any loans between the parent and sub. You know, an accounts payable for one and an accounts receivable for the other. Poof, they're gone. Second, any sales between them. Not a real sale to the outside world. Gone. And third, any dividends the sub pays to the parent. That's just moving cash around the family. We eliminate it. Okay, everybody lean in, because this is the rule that separates people who pass from people who don't. You must eliminate 100% of the intercompany transaction. I don't care if the parent only owns 80% or 60%. If the sub sells $1 million of inventory to the parent, you eliminate the entire $1 million. Why? Because the parent has 100% control. And 100% control means 100% elimination. That is a non-negotiable rule.
Okay, so we're all on board. We eliminate 100% of transactions because we have 100% control. But wait a minute. What if we only own 80% of the subsidiary? We're still combining 100% of their assets and liabilities into our statements, but we don't actually own all of them. So what do we do about that other 20% that belongs to somebody else?
Think of the subsidiary like a big apple pie. We, the parent company, went out and bought 80% of that pie. But for consolidation, we have to put the entire pie on our balance sheet. We can't just pretend that last 20% slice doesn't exist. We have to show that, hey, this slice belongs to some other owners outside our company.
And that 20% slice of the pie has a name.
It's called the non-controlling interest, or NCI. And you can bet the exam loves to ask where this shows up on the balance sheet. The answer? It goes in the equity section. Why? Well, because it represents an ownership claim on the family's assets, even if it's not our claim. It's part of the total equity of the consolidated entity.
Whew, we have covered a lot of ground, from the big picture theory all the way down to the nitty-gritty details. So now, let's put it all together into a simple, step-by-step process you can use on exam day to attack any consolidation question.
All right, here it is, your 4-step battle plan. Step 1, first things first. Do we have control? Is ownership over 50%? If the answer is yes, we move to step 2. Combine 100% of the parent and sub's assets, liabilities, and equity. Just add them up. Step 3, eliminate 100% of any of those internal pocket-to-pocket transactions. And finally, step 4, if you don't own 100%, you have to carve out the piece you don't own, the non-controlling interest, and report it in the equity section. That's it. That is the whole game right there. You see, once you start thinking about consolidations as just one big economic family, all those weird rules suddenly start to make perfect sense. You've got the framework, you have the attack plan, now the only thing left to do is put it into practice. Go find those tough multiple-choice questions, but ones that mix intercompany sales with a non-controlling interest. That's how you'll really lock this in, and that's how you're going to earn the points that get you that CMA certification. You are ready for this. You've got this.